Hello and a very warm welcome to this, the first episode of the Theory of Commodity Spread Trading. I'm very happy that you decided to take this course to start you on the road to becoming a spread trader. We'll take things slowly, starting with the basics, before moving on to the more interesting and operational aspects in later videos. Don't worry if at this stage some of the concepts are not immediately clear. This is only normal when you're starting something new. It was for me, and to be honest, it probably was for all new traders when they started their learning journey. You have to start at the beginning. This is always the case with a new activity, but I guarantee you that in a short time the steep learning curve will start to level out and things will become easier to understand. The possible fear of learning something new will abate and we will begin to enjoy our time together more and more. At this point in time, to be perfectly honest, you will need to have a little bit of patience to master the basics, but eventually, with perseverance, you'll be in a position to reap the rewards. This first episode is aimed at giving you an introduction to the world of commodities and is split across two videos. In this, the first video, we will look at what is a commodity, why trade commodities, and finish off the session by looking at the types of commodities. Now, we need to understand the basics and will therefore have to understand certain terms or concepts. Now, don't worry, this isn't going to become a classroom session. We just need to ensure that you understand some of the fundamentals before moving on to more complex matters. A quick definition for the record. A commodity or raw material is a natural resource that can be subjected to processing and selling. They are the essential components for the creation of other goods. Think of them as the building blocks that underpin the production of food as well as industrial and domestic materials. They are something tangible that we see every day on our table or otherwise make daily use of. We use commodities to improve the diversity of investments in our portfolio, and this is something that we will look at later on in the course. Let's look at why we use commodities. There are many factors that can influence the markets and the price of not just commodities but other financial instruments as well. Factors such as the impact of inflation can cause markets to change. We can use commodities to help offset this and benefit from the seasonal cycles which influence commodity prices. This last part will be explained in more detail later on in this course. So, looking a little deeper at these factors, starting with inflation. A commodity can be used as a natural hedge against inflation. They are real physical products and they react well to the risk of inflation, often rising in price as stocks and share prices fall. They're among the few financial products to do this, so using them in your portfolio could be seen as an insurance against inflation. But we can also look to use them as a long or very long-term investment. Now, when investing, it's always advisable to diversify across your portfolio by investing in different instruments and markets to reduce risk. It therefore makes sense to have a portion of our capital invested in raw materials, which often take a reverse trend compared to the stock market, thus ensuring greater coverage for the entire portfolio. From the knowledge gained from this series of videos, you'll discover how spread trading gives you the ability for even greater diversification compared to using traditional investment instruments such as stocks and shares of the raw material. Now, on this slide, we see a chart. This is going to be the first of many that we see on the course. The information shown represents the increases and decreases of climatic temperature over the course of a year. Using this information, it's not difficult to make a prediction. Temperatures will drop during the winter months, whilst in the summer they will increase. Fluctuation in climatic conditions, as well as other global factors that we will explore further in the next video, cause commodity prices to rise and fall at certain times of the year. The price of raw materials follow a similar pattern. They are impacted by, and therefore related to, seasonal trends that these factors create. For example, it's easy to see how the price of energy commodities tend to rise in the winter when there's a greater need for heating. The same can be said for other types of raw material. Wheat prices, for example, can change according to whether it's the sowing or harvesting season. This is an advantage that we need to understand, knowing that it's a cyclical condition and that it is repeated every year. Only the commodities market has this statistical and predictive advantage. Knowing in advance what the seasonal changes of various goods are means that you can anticipate the price movement. Add to that the knowledge we will give you over the next few videos and you too will be able to take advantage of it and in turn start to make a good profit from your investments. It's important to understand that raw materials can be grouped according to some of their common characteristics. In the following section we will explain these in more detail, so that you will understand why we treat them differently, apply a different investment criteria in respect to them, and above all, how they can be used to fulfill different roles in the composition of our investment portfolio. Commodities at a high level can be grouped into two main categories, soft and hard. In the next few slides, we'll look to understand what the main differences in respect to this are and explain how commodities are classified. So, looking at the soft commodities, these are raw materials which are grown or bred, not those that are extracted. The price of raw soft materials tend to be quite volatile in the short term due to the risks arising from their perishability, which can cause sudden instability. Prices are also affected by the natural growth cycle that can create significant seasonal fluctuations. We can take advantage of this volatility and use it to our advantage, but at the same time we have to manage the risk it generates accordingly. The classic soft commodities are corn, wheat, cocoa, orange juice, and even livestock. Raw materials that are extracted from the subsoil or derived from other natural resources are defined as hard. They are also those materials that come from the processing or refining of the base material, such as oil, which can be converted into petrol. The most classic hard commodities are petroleum, natural gas, and then the metals of aluminium, silver, gold, and lead. There are, however, exceptions to all rules. There are some agricultural products, such as cotton, that despite being grown, and therefore you would think of as a soft commodity, fall into the hard commodity group. The reason is it doesn't deteriorate rapidly and is mostly used as an industrial or production material rather than being a food type. As we've just seen, we can define a commodity as being either hard or soft. We can take the classification further and split them into groups where the products are either related or have similar properties. This grouping can help when determining how to trade with commodities, and this will be explained in a later video. In the following slides, we will explore the various groups a little more, looking at which commodities make up each group and the relationship between them. Soya, as an example, can either be traded as a base product, soya beans, which is the product that's grown, or in the case of oil or meal, the derivative that comes from it. Grain, however, is a group that is made up of products with similar properties. As you can see here, they are all products that are sown, grown, and harvested. It's a similar story with meats, this group being made up of products that relate to livestock and the various stages of the animal's lives at which the product is used. Tropicals group together those raw materials that are grown in the sunnier or tropical climates, where there's a need to have a warmer growing season, as this has a direct influence on the size and the quality of the harvest produced. Moving on to the hard commodities, we see that metals can be grouped together. It should be noted that even though they're grouped together, they may trade on different exchanges and possess different properties in respect to values as a precious or industrially used material. And finally, we would group together those raw materials that are used to provide energy. As we saw earlier with soya, the products within this group could be the base raw material, for example crude oil, or one that's produced as a result of the refinement of it, such as heating oil. In all cases, they still possess similar properties and are influenced by the same seasonal factors. There are so many different financial products to use, but an initial advantage that we would like to point out is that by simply staying within the field of raw materials, you can diversify your investments within your portfolio to offer protection against market movements as well as making longer term investments. As a recap, in this video we've looked at what raw materials are, some of the advantages of trading with them, and how they're categorised. To continue the journey, we'll move on to the second video, where we'll cover more of the basic information to allow you to get to know and understand raw materials a little better, looking at who trades commodities, the factors that influence them, and how they can be used for investment. I look forward to speaking to you very soon. Bye for now.